Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the daily recap. So today we got a new all-time closing high in the S&P, but that all-time intraday high is still proving elusive as we had a little bit of a quiet day in the markets, and I think that's what the bulls like to see at this point. We've gotten used to it in 2013 so far as this melt-up, quiet type action, and that seems to be what we're returning to after a couple weeks of more erratic, volatile action at upper levels, which is often seen as a red flag and a potential sign that a deeper correction could be imminent, but now we've returned to this quiet, low volume, grind higher type environment that I think traders like to see. And despite the fact that markets are quiet, you still have a lot of movement in individual stocks if you're paying attention to volume and higher than normal average volatility, things like that, average true range, different things that we use to screen for stocks that are in play and stuff like that. But some of the things we talked about this morning in the daily recap, I talked about with Brittany, came to fruition very well as you're continuing to see money rotate into technology stocks as we see sector rotation, and then a lot of highly shorted stocks made really nice moves. But first we'll go to the chart of the S&P, or we'll take a look at the spiders of the S&P ETF, and as you can see, we're up back right to near these all-time highs. We closed at a new all-time closing high, but within cents of that intraday high, so I guess you could still say that all-time intraday high around 1597 on the S&P is resistance, but it doesn't seem like it's going to be much resistance. It's going to be able to do much to stop this freight train that is the market right now. So besides that, there's not a lot of patterns really to note in the S&P. It's above the 8 and 21-day moving average, obviously above the 50 and well above the 200-day. So it's just back to normal 2013 market, the new normal, the new grind higher market that we've all grown accustomed to so far this year. And we are heading into May. Today was the last trading day of April, so could we see that sell in May, go away adage hold true? Who knows, but right now there's no reason to lean anything but long for the most part. Maybe you balance your book a little bit with some shorts, but we'll go into that here in just a moment. So stocks we talked about this morning with high short interest. These are stocks that a large percentage of their float is held by short positions, and a lot of those stocks were very active early in today's session. They tailed off a little bit into the close, but I still think you're going to continue to see these types of stocks get a lot more attention and continue to have runs as the shorts go on the run, to not use the same word too many times. But we go to the chart of Tesla, and you can see today, like I said, very early bullish price action. And we'll go to the 60-minute chart to get a look at it. If my chart will come up here, we'll go get the 24-hour activity out of there. You can see very strong early in Tesla. You know, it's one of the most highly shorted stocks out there, a 50 or 60% short float. Not a lot of people have covered. I think I talked about it this morning that at one point, over a couple weeks ago, it was 3.1 million shares short, and then it recently moved to about 3 million. So you're seeing a large percentage of these people that are sitting short Tesla have not covered. So I still think there's a lot of fuel left in the tank. But today, this topping tail might be a little bit of a damper on the stock for now. And I think you could get some pullback type action, a retracement back into the short-term moving averages. It's a little bit dangerous to be looking to buy a stock as it's extended from its 8 and 21-day moving averages, but I think if you do get a pullback in Tesla back into that $50 area perhaps, I think Tesla has more upside. And I'm a big believer in Elon Musk, the genius CEO of Tesla. He's also involved in Solar City, SCTY, another symbol that's very successful, and then a privately funded project called Solar X, which is trying to bring space exploration in a little bit more mainstream. But big believer in Tesla. I think on a pullback you could potentially get some more squeeze action on a bounce. And FSLR is another name. If we go back to the chart, one of the other main focuses among these highly shorted stocks, and it has about a 36% short float, and you've continued to see shorts get squeezed following this big igniting bar from down near the 200-day moving average. This igniting bar came when they revised forecasts a lot higher. A lot of that was a new efficiency standard they were able to create and some new solar panels that they have produced, and you saw a really nice flag in FSLR, and then it's basically a picturesque type pattern that we like to see. We blogged about it. You like to see it hold the upper portion of this igniting bar and then go higher. We saw that here above $40, and then we're seeing that again with another type pattern. This is another one that's extended off its 8 and 21-day moving averages, which is a little bit not what you want to see in the short term if you're looking to be a buyer. For example, after this igniting bar, you got some digestion right here to allow the 8-day moving average to play catch up, and we could get a similar type of situation as the 8 days a little bit extended off of the current price level for First Solar. One that did not get any bullish action today, a lot of these First Solar, Tesla got really strong bullish action early and then tailed off, but JCPenney didn't get any of it. It was weak all day, despite the fact that two large hedge funds reportedly have bought into this stock. You have George Soros taking a stake, which you don't often see those high-profile type investors take big stakes in companies with the weak financials that JCPenney has, but Soros has been known to sometimes try to make a contrarian play a little bit. But it'll be very interesting to see whether JCPenney can bounce off of its moving averages now that are starting to curl up. You have the 8 and 21 moving average starting to curl up, and that'll be a very important test for JCPenney to see if it retests those lows or whether this is just some profit taking after a big move late last week. CLF is another one of those highly shorted names I talked about this morning, one that I actually own. I bought it before earnings around just under the $18 level, and we've got a nice move after earnings, and this is another one that is gapped up and putting in a nice flag that I think can lead to more of a squeeze once it breaks above this $22 area and it breaks above the 50-day moving average. Today that 50-day acted as a little bit of resistance, and CLF wasn't able to hold some of the intraday gains, but it does look right to me for more of a short squeeze. And if you zoom out on this chart, you can see how far it came. It was a $100 stock back in early 2011, and even in 2012 it was up $70, $80 area. So obviously it's an over-levered business, mining company that is in a natural resources industry that's struggling a little bit right now, but I think as a contrarian play off of some major support down here, near some major support, that's why I was interested in potentially trying along at CLF, and I think it could be right for more of a short squeeze. Another one of those that has been quiet over the last few days is Netflix. Netflix is one, obviously, has gotten a lot of attention over the last few months after this blockbuster earnings report in January sent it sharply higher, almost 100% move, in fact, in about a month for Netflix. It sort of looked exhausted, was basing. It had a nice little breakdown that you could have targeted as a short out of this upper level base, but another earnings report, another gap up for Netflix, and it's once again putting in a really tight flag. And if you're a little bit uncomfortable looking to buy Netflix up here, first of all, I wouldn't be, because just the mechanics of the trade, the fact that it still has a 20 to 25% short float, and you just really have a nice upper level base to base either a short or long entry on Netflix right now. It doesn't matter where you're leaning. I think you use the bottom and top end of that channel as your entry points on a potential trade, either long or short. That's why we really like these tight flag type patterns, and either way I think you'll see the stock rest until the 8 and 21 day moving average play a little bit of catch up. At that point I think you could get a break out of this range either to the upside or downside in Netflix. Another one of these highly shorted names to continue with this theme, LinkedIn was sort of Netflix's cousin this most recent earnings season. Netflix reported earnings and gapped up and became a leader for most of the first quarter, and it was a similar situation with LinkedIn. It wasn't quite as extreme, but you saw a highly shorted stock gap up on earnings and never look back. It remained in a tight uptrend and has remained in that uptrend all the way through till today and made another new all-time high today. Continues to be just an incredible story. All these social networking stocks have ran into trouble, but LinkedIn has proven to be the one that actually has a profitable business model, or one that could become very profitable in the future. And it has earnings on Thursday, so that'll be very interesting to watch whether they can deliver another blockbuster report and perhaps follow the same trajectory with a second straight gap up as Netflix. So LinkedIn definitely want to keep an eye on ahead of those Thursday earnings and even afterwards, of course. One I did not talk about this morning was BlackBerry, because I'm not a big believer in the company overall, but I generally don't try to let my opinions about companies influence my trading opinions and decisions. And BlackBerry, we've talked about this wedge pattern that has been forming recently. If you draw our lines here, a nice defined wedge that it broke out of today. A wedge is one of our favorite technical patterns because, like that upper level flag that we talked about in Netflix, it just gives you areas to enter or long or short the stock based on whether it breaks up or down out of the wedge. And normally you see a wedge really tighten to closer to an apex before breaking out, but sometimes you can get an early breakout. And it looked like today BlackBerry on a nice volume traded out of the wedge, and it did close a little bit off its highs, but it was actually able to hold on to more gains than a lot of the other similar type stocks we've been talking about so far in this recap. And I think it's one that could potentially squeeze back up to this $18 level as sales on their new phones have actually been fairly good, even though I don't think long term that this is anything in the way of a game changer for BlackBerry. I think it's a company that's dying, and I think revamping their phone lineup was a good step, but I don't think they're going to be anything more than a niche player in the smartphone industry. You have to talk about Apple today, obviously. Apple's the biggest component in the NASDAQ and a big influence of market direction, or so we thought until the market made new all-time highs while Apple was losing 40% of its value over the past 6 to 8 months. But if you go to the chart of Apple, very productive day to day, continued with that run it's seen since its earnings report. It bounced. Its low was prior to the earnings report, around 385. The earnings report came out. Initially after hours, the stock went higher, then it was lower, and then it traded from negative to positive on that post-earnings day, and then it really hasn't looked back since. It reclaimed its 8-day moving average, has seen interest increase day by day. Something I tweeted about today is that Apple's the type of stock that it never makes it easy for traders. If you're going to be involved in the trade, you almost have to be uncomfortable at the beginning when you initiate your position. And I think at this point there's a lot of people that are saying, man, I really want to be long Apple right now, but I don't think, if Apple is really going to go, I don't think they're going to let anyone in comfortably. If you do get a comfortable pullback that you feel comfortable about buying, then I don't think the stock is going to end up making that move that everybody wants it to make. I think if it's going to make that move, it's going to continue what it's doing right now. It's going to gap up, it's going to trade higher, and it's not going to let anyone feel comfortable, to keep using that word, a way into the move. And I think you could wake up one day and you'll see Apple back at the $480, $500 level, and everyone's going to be kicking themselves for not being involved in it. But there's very strong demand for their corporate debt today. It was they announced the biggest corporate debt offering in U.S. history. It was 3 times oversubscribed. People really clamoring for that defined yield, a little bit higher yield than you'll get with U.S. Treasury bonds. So the story is changing a little bit on Apple as they start to placate those people looking for more value from that stock. And any new product launch, I think, would be a big catalyst for Apple at this point. But that'll about do it. You saw some other strength in technology stocks today. You saw Microsoft and Intel continue higher. It's sort of hard to chase those if you're not involved already, but it's something to note. And in the closing of the morning call this morning, Brittany asked me what my focus was going to be, and I said, I think technology stocks will continue to see money rotate in, and that's what we saw today, and I think it'll continue to happen, as that's one area of the market that's not terribly extended. You have stocks like Apple, you have stocks like Microsoft, and stocks like Intel that over the last week or so they've been very strong, but on a swing type basis over the last few months, while the market's been making new all-time highs, these stocks have been lagging and holding down the NASDAQ ETF, the Qs. So I think you could see the Qs play some catch up to the other broad indices. I think you could see some of those tech stocks continue to see money rotate in. But this has been John Darsie for the Daily Recap. We'll see you tomorrow morning in the morning call. Actually, Scott will be back, so you won't see me, but you'll see Brittany.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our 2 very popular newsletter products, Off the Charts and the Price Point Sheet, at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.